But the other mode of thought with regard to a potential pivot is something breaks. And Morgan Stanley came out yesterday with a headline saying something is about to break.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today I'm quite excited to welcome back on in David Brady of Sprott Money News, silver chartist, veteran of these markets. And David, it's been far too long since we've caught up and talked about some of the fascinating things going on in the world and in the financial markets, which we will dig into today. But first of all, it's a pleasure to see you again. And how's everything going with you today?
It's great to talk to you again, Chris. Yeah, it's all good except for gold and silver, but we'll get into that momentarily.
Well, certainly is the case, especially the inflation has finally arrived. Gold and silver responding perhaps more so to the Fed's policy, which perhaps a good place to start because it seems like we've finally reached the point where now the Fed raising interest rates, but for a while it was almost as if the markets earlier this summer didn't believe that they were going to continue doing that. Yet now we're starting to see some of the effects. Continue to
Hmm.
get weaker housing data. We're seeing it in the currencies, the British pound running into trouble over the weekend, Japan intervening in their currency last week, dollar index continuing to soar, making life in the emerging markets not the easiest of times. So why don't we start there and what you're seeing in response to the Fed's interest rate hikes and some of the chaos that is beginning to pick up out there?
Well, yeah, it's one of the factors that I'm looking at with regard to the potential Fed pivot, which the Fed Powell and latest person is Mester, have been trying to make the case very forcefully that they will not be cutting rates next year, much like the bond market seems to suggest. But there are several triggers for a Fed pivot. I mean, there's numerous ones, but the most obvious is, a sharp drop in inflation, and that would be driven by a strong dollar reduces import prices. So the cost of everything that we're importing, which is massive, starts falling. Second, you got this bullwhip effect at the retailers. The likes of Walmart, Target, and Restoration Hardware are going to be dumping inventories on the market at massive discounts. So you got that too. And then you got demand is drying up because you got consumers tapped out. They're maxed out on credit cards. The savings rate is in the toilet. So we're going to see a reduction in inflation going forward. The question is, how fast does it occur? Because if we get a sharp drop, that'll, be a wake-up call for the Fed. But the other mode of thought with regard to a potential pivot is something breaks. And Morgan Stanley came out yesterday with a headline saying something is about to break. And I've been warning about this for the past few weeks now as well. And I'm not alone. I'm standing on the shoulder of some great giants. But the one piece that I'm looking at is the junk bond index, and specifically leverage loans. And leverage loans are secured loans to very low credit quality borrowers, and they tend to be variable rate. And what happens after those loans are put in place is they tend, like mortgage-backed securities, they tend to be securitized and sold as a bond backed by these leverage loans. But the problem you run into with the Fed raising rates so quickly and dramatically is that the cost of those, the interest cost on that debt is soaring for these low credit quality borrowers, which are already using that vehicle to get money they could otherwise not get. So then you jack up rates. They've got to be on life support right now. Now, when you consider that and the fact that the economy is in recession, it's already in recession, and that means that revenues are likely falling. At the same time, inflation is still what? 7, 8, 9%. If you go to shadow stats, it's a lot higher. Their costs are going up dramatically. So revenue's going down, costs going up. Oh, and by the way, you got to pay maybe 4, maybe 8 times what you did before in interest costs on the debt that you borrowed, because essentially they got that debt at 0 to 1%. And now rates are above 3%, going towards 4%. There's got to be a lot of very weak companies out there that are on the brink of collapse. Now, if you recall the subprime debacle back in 2008, that started in the junkiest of junk, the double Bs. And anybody who's seen the movie The Big Short knows this. That started in double Bs, and then the Fed addressed it to some extent. And Bernanke came out with his famous line, subprime is contained. What happened next? The domino started to fall. It started to spread to the rest of the sector, ultimately taking down even some AAA bonds. So my concern, and it's held by other people too, is that this starts in an obscure section of the market, such like leverage loans first. And we're already seeing defaults soar, by the way. I can give you the data on that later. Then it spreads to junk bonds in general. And then it spreads to BBB investment grade. And then it just keeps going. My point is that everybody's looking at stocks. Others are looking at forex. And you know, I'll admit, the whole world is on fire right now. Volatility is all over the place. But I'm looking at bonds. And because, you know, the canaries in the coal mine is the junk bond market, in my opinion. And if that goes down, the Fed's going to have to do something. Otherwise, you risk the entire bond market being taken down. And if the entire bond market, including sovereign debt, starts to collapse, it's game over. So, and then on top of that, you look at, I saw a headline yesterday that the student loan forgiveness, which was, I think, estimated to be around 100 billion, is now planning to be 400 billion. Yeah. This is on top of the 1 trillion they're spending on this ESG policy via the Inflation Reduction Act, which is nothing of the sort. That's another trillion. The government, if you want to reduce inflation, you reduce spending. What are you doing? You're increasing spending. So they already have a 1.2, 1.5 trillion. I lose count sometimes. The numbers are just mind-boggling. Budget deficit. And now they're piling on more spending as tax receipts are going down because, you know, look at stocks. What kind of capital gains taxes are you getting on stocks these days? Right. Probably big fat zilch. Corporate tax. Well, what's happening to earnings if your revenues are being squeezed and your costs are going up? That's going down. Income tax. I don't believe a word with regard to this, these employment numbers. It's pretty obvious to me that employment is soaring and unemployment is soaring. So now income taxes are dropping. So if you look at the government's balance sheet or budget, their revenues are dropping. Their costs are going up because they're spending like drunken sailors. I don't want to sound like a broken record, but I've said this numerous times. Who's going to buy the debt? Yeah. I mean, China's dumping theirs. Russia's already dumped theirs. Now Japan is dumping their treasuries as well to support the yen. Who's going to buy the debt? ECB is buying their own debt. They've got to bail out Italy and so forth. Who's buying the debt? Don't give me the money market funds. They're already up to their eyeballs in debt. The commercial banks too. Who's going to buy all these treasuries that have to be issued? Not just the ones that are maturing, but the new ones that they're going to have to issue to finance all this debt. There's only one answer: the Fed. So when you put all of these pieces together, to me, it's obvious that a pivot is coming, because the alternative is total collapse of the system. And yeah, it's a viable alternative, but you know, it's relatively low probability. These guys like to kick the can down the road as long as possible, unless they've decided that they're the 1929 Fed and they're going to pull down the entire market, create a systemic collapse across the world now. Yes, it's a probability, but for me, I'll go with history and looking at all of the various pieces of data. It's more likely that they're going to step in one more time, because my 2 cents is that there's a plan to create a new global reserve currency. The BRICS have already announced that. But in order for that to happen, you have to take down the biggest guy on the block, and that's the dollar. Well, how do you destroy the dollar? You print it into oblivion. So I still think there's one, I could be wrong, but my core belief is that they will pivot. And, whether it's any of the reasons I've just mentioned, or it's, China invades Taiwan, China announces how much gold it actually does have. The BRICS announce they're switching to a different global reserve currency, which is a basket of currencies backed by commodities, which they've already announced, but now they codify it. There are so many triggers for the Fed to pivot. And when I see the Fed members tripping over themselves to say that they won't cut rates next year, that they will keep going until they bring down inflation, they know that interest rates have little effect on inflation, say for causing a recession and reducing demand. But the primary driver of inflation in the United States is supply side. And they have little to zero control over that. So for me, this is all an exercise in trying to maintain the credibility of the Fed after losing it with their inflation is transitory comments last year, which we all knew was nonsense, and also to create ammunition for when the recession becomes blatantly obvious or something breaks. Because I mentioned maybe perhaps a sharp drop in inflation forces the Fed to pivot. The other thing that would cause them to pivot is if GDP came out with a -5% number in Q3, something that says it's obvious now there's a recession, and unemployment spikes higher. So there's so many triggers for a pivot, whereas the alternative is total collapse. I will admit that total collapse, systemic collapse, starting in the US and then around the world, or starting in the emerging markets and spreading to the rest of the world, is definitely a possibility. I just think it's a little further down the line. I think there's going to be one more melt up. The Fed's going to ride to the rescue again. And the end game for me is that ultimately people lose confidence in Fed policies, lose confidence in the dollar, lose confidence in government policies. And how do we know this? When they are printing money and inflation is soaring, but the stock market starts going down, it doesn't respond. In other words, they're firing blanks. And when that happens, then it's game over, because they've no other tools to control the economy, and they pull the plug, and there's your great depression and your great reset and yada, yada, yada. But yeah, the highest probability is that they'll pivot. The only question is when. But when I see headlines from like Morgan Stanley, and there's others starting to talk about it too, that something is about to break, I believe it's going to be sooner rather than later.
Yeah, it seems like they're trying to walk a rather fine line there. And I mean, on one hand, I suppose if I put myself in the Fed's shoes, well, maybe I would have not done what they did back in 2008 yet. All right, I get it. When you have inflation soaring, people are finally starting to notice it. I think a lot of the things, for years, it was gold and silver bugs saying, hey, watch out for this money printing, inflation's going to go up, and people discounted it. But now it's become a national story. Now even Joe Biden can't ignore it. So I get it that earlier this year they were raising rates and seemed like no one believed them for a while, though now, as you quite eloquently pointed out, we're starting to run into trouble. And even seeing oil trade below $80, and some of the factors you mentioned where you have inventories building up in retailers,
Yeah.
You think it's a matter of at some point in the next couple months? I mean, so far we haven't seen even, whatever credibility one wants to put in the CPI as a measure of inflation. We haven't seen these numbers come down a lot. Although, do you think that's something that could start dropping more noticeably with what you mentioned is going on? And then you put in combination, I mean, we see Credit Suisse default swap contracts trading higher. And then if something breaks, that it could be, because like right now, where it seems okay, maybe still a bit far off when you have the 8-9% inflation, yet possibly something that could change quickly if you do get a breakage somewhere.
Yeah, but if you look at you're absolutely correct. If you look at the myriad of factors going on right now, you got a housing market collapse, you got a stock market bear market. I mean, and it could get worse. You got bond yields. We've broken the 30, 40-year bull market in bonds. And now we've got a 10-year around 4%. And it's not just the level, it's the speed at which they have risen. And then I mentioned junk bonds. You see the dollar at its highest level in like 20, 30 years. You mentioned Credit Suisse. All of this is all connected because the banks are the ones that are giving out the mortgages. The banks are securitizing a lot of debt, much like that's one of the reasons why Bear Stearns and Lehman Brothers went under. I didn't mention that in my lists of triggers for a Fed pivot, but what if we see a major bank collapse somewhere in the world, Deutsche or somewhere else? Then the domino effect starts to kick in again. What if an emerging market, a country, we've seen Argentina is in dire straits right now. What if we see a major default on debt? What if we see a sovereign debt default? My point is that there are so many things that could break here. And this is what happens when you have dollar at 20, 30-year highs. You got rates being jacked up at the fastest rate in at least since Volcker's period. And, you got stocks that are collapsing from extreme levels, even in, PEs that were in excess of the dot-com bubble. And they're still not back to fair value. There's just so many things that can go wrong. And this is what happens when you have a centrally managed economy. And when I mean centrally managed, you got the Fed is at the center of everything. Everything that's happening right now is due to the Fed. They blame Putin. They blame COVID. It's the Fed's monetary policies in conjunction with those of the governments. But the politicians just spend because they have the central bank there to buy the debt whenever they feel like it. So, if you've got a blank check, of course you go out and spend as much as you want. And that's what the Fed provides the government. So the Fed is at fault. It's the central bank, and it's all the central banks. We focus on the Fed because it's the US, but it's the ECB, the BOJ. The BOJ is a joke right now. They're trying to prop up their bond market by buying the bonds, by printing yen and buying bonds. And then the yen collapses, and then they try to buy they try to prop up the yen by selling US treasuries to buy yen.
Right.
Does anybody ever heard the game of whack-a-mole?
Yeah.
Yeah, I mean, it's just bananas. You're driving the yields on bonds are going up. You can't have that because the insolvency of your country will become blatantly clear to everybody if it goes above 2%, the 10-year JGB. So you need to buy the bond. You print yen to buy the bonds to keep the yields low. The yen drops like a lead balloon. Then you take your treasuries that you still have left and you're dumping to get dollars to be able to prop up the yen. Sustainable, do you think? How much treasuries do you have, Japan? Because once you run out of treasury, what are you going to do next? Get loans from the US? Probably. You're going to get lines of credit, much like they did in 2008, and keep doing the same thing. In other words, it's unsustainable because it's nuts. There's just so many things going wrong. The only thing that can save the entire system, because it is a Ponzi scheme, is the Fed is going to have to print again, and the ECB, and well, the BOJ already is, but they're going to have to print again, or it's total systemic collapse, and you get your Great Depression, and you get your Great Reset. And then they figure out what to do with the debt. Repudiate it, jubilee it, I don't know. But that's where we're headed. And I don't see any alternative to central bank printing other than total systemic collapse. If they are the 1929 Fed and they've decided to collapse everything, well, there you go. But one thing I will say in a quick aside, everybody's focused on the drop in gold and silver right now due to Fed policies and so forth. And the fact that they're emphasizing that they're not going to pivot anytime soon. They're going to keep rates high because they have to conquer inflation. Well, if they do cause a systemic collapse, which do you think falls faster in these groups? Stocks, bonds, real estate, gold, silver. Which do you think is going to fall the fastest and which is going to fall the slowest? My point is, gold and silver outperforms at extremes of inflation and extremes of deflation, because they will fall, confidence will be lost in all fiat currencies at this point. And gold and silver will at least maintain their value, or much more likely increase it relative to tangible assets like real estate. So it's going to go up either way. But when you have the dollar, which is getting devalued daily, but at a slower rate than other currencies, it looks relatively strong. But it's only a matter of time before its day comes where it starts to turn down in a big way. And that's when gold and silver shine. But even if we get a total systemic collapse, it'll shine then too, because it'll be worth more than anything else. It'll fall slower than anything else, much like the dollar is doing relative to the euro and yen today.
Yeah, and I'm glad you brought that up because I think that's something people wonder about. Where, on one hand, if we do get more money printing, I think that's easier to see the environment where gold and silver finally going back up again. Although, if we do get this systemic collapse, I guess that was the two buckets that I always looked at when I first got into gold and silver: one, currency expansion, or systemic chaos. So perhaps you could just talk a little bit more if we do get what I think you and I might agree is less likely of them letting the system just completely collapse. But perhaps you could just touch on what you think it would look like with gold and silver in that environment.
Gold and silver in a collapse environment?
Yeah, if they actually let the thing go without a pivot.
Well, then we talk about cycles and relative undervaluation and overvaluation. If you look at stocks relative to their P's, relative to history, they're obviously extreme overvalued, or were, but they still are. Bonds were extreme overvalued. They were in a 30, 40-year bull market. Well, they've broken that now. Now those numbers are correcting, but we're nowhere near the numbers that they were in like the 1980s, for example. Real estate, that's an easy one. I mean, I don't know. I'm sure there were similar situations all across the US, but here in Canada, we were seeing property prices go up 100% in the space of a year. It's nuts for a real estate market like housing. But there you are. And now it's going in the opposite direction in a hurry. Whereas silver on a inflation adjusted basis is still half the price it was in 1980. 42 years ago, if my math's correct, and it's half the price it was, even though it's used in solar panels and so forth. Someone explain that to me, William Banks. And then there's gold. Gold is horrendously undervalued also, relative to, just look, I've done this. It's simple math. Take the price of gold today and the price of silver, and you can put in the numerator and the denominator relative to the median home price in the US, or do it relative to the Dow or the S&P, and take the 1980 value, get the 2000 value, the 2011 value, And just look at those and then calculate what it is today. And it'll tell you a story. It'll tell you that gold and silver are dramatically undervalued relative to those assets, housing, stocks, you name it. When anything is extreme undervalued relative to something that is extreme overvalued, this is where cycles kick in. What tends to happen? The undervalued asset tends to go up in value relative to the overvalued asset. And if you just do those calculations for those dates I've mentioned, you'll see just that. And here we are down here in the sewer somewhere for gold and silver. So my point is that even in collapse, yes, gold and silver may fall relative to the dollar. I doubt it, but it could. But housing and stocks, look, I'm on record for saying I believe that the S&P is going to go below 1,000. Not tomorrow, after the next melt up. House prices, we could see another 1930 situation where you have 2 bidders for every 100 foreclosed properties. You could buy a McMansion in Connecticut for $1. People are bulldozing their houses to avoid paying the property taxes. That's where we could be. And I think it was 1 gold coin could buy you a street in some locations of houses. 1 gold coin. So my point is that gold and silver may go down. I doubt it. But relative to other assets that are extreme overvalued, which is what really matters, it doesn't really matter what it is in fiat currency, especially if that fiat currency is going to become worthless. It matters what it's worth in terms of tangible assets. What can you buy with it?
Right.
You know, and in a deflationary scenario, you want to have gold and silver when that hits. And in a hyperinflationary scenario, it works at extremes. When everything's peachy in here in the middle, you're better off in something else. But when it's extreme undervalued and you've got either situations such as hyper stagflation, as I prefer to call it, or outright deflation, your only safe harbor is gold and silver.
Well, I think that's a great way of phrasing it, with the extremes, because, you know, if you look in terms of just money supply, okay, with the Fed raising rates or tightening, then, you know, it's going in the opposite direction, but not quite that simple. And I think, like you point out, the extremes is where that would come in handy. And unfortunate that we're in a situation where it seems like one of these extremes is in some way inevitable. I think a lot of the things that gold and silver advocates have been talking about for years, or in some cases even decades, it seems like they are rapidly manifesting in the world, which is unfortunate because you see how these things affect people. Although just appreciate you putting things in perspective today, David, because it's certainly a challenging time out there and not the easiest news to digest, but I think this will be helpful for people to at least get a grasp of what is coming. And perhaps before we wrap up, could you just let folks know one more time where they can find you and the writing you do and any research that you're putting out?
Yeah, I will. Can I just make one last point, Chris?
Sure.
I'll just get this in. They're planning on rolling out universal basic income at some point and central bank digital currencies. I'm just going to leave this with you. What do you think that's going to do to gold and silver if they roll out UBI? More free money, no production on the back end. In other words, more free money chasing fewer and fewer goods and services. What happens to inflation then? And central bank digital currencies that can be created at a whim. What do you think happens to something that can't be printed like gold and silver? Just think about that. The other thing I wanted to mention quickly was everything in gold and silver other than the Fed is bullish. We have funds, money managers, as they're called in the COT. They are they are short gold and silver. The banks are close to neutral. In silver, the banks are long gold and silver. The commercials are long. You've got sentiment back to bearishness in gold and silver, especially gold, back to 2018 levels. You have technicals with like MACD in silver, or sorry, gold is going back to, it's at its worst since 2013. I mean, we're seeing such extremes. You got 10-year yields that are at their highest level since, when we see, was it April 2010, 12 years ago? What's the risk reward there? It goes down. You've got the Dixie is at its highest level since May 2002. Risk reward there keeps going up. I don't think so. Something's going to break. My point is, you've got extremes all over the place. The only factor that is remaining in my process, which is fundamentals, intermarket analysis, positioning, Elliott wave theory, sentiment, and technicals, that is missing is the Fed, the fundamental. They're the only fundamental that matters. So if and when they pivot, or gold and silver anticipate they're going to pivot, they're going to take off. So I just want to leave that before we finished up. And yes, you can find me at Sprott Money on a weekly basis. I contribute an article to those guys. And I'm also at silverchartistpro.com. I write for that weekly subscription-based service. And then you can find me for free on Twitter at Global Pro Trader. And I pontificate every day on what's going on, right or wrong. One thing I'll say as an Irishman, I'll tell it like it is. There's no fluff. I'm allergic to that. But you won't get cheerleading from me. So take it for what you will. I just sharing what I think, and hopefully it's beneficial to you.
Well, I sure appreciate that. And I don't know, in my opinion, certainly not a time for people to be sugarcoating things. It's good to have people that have your experience out there sharing what you're seeing, and at least letting people know what's going on out there, which, whether we like the way the developments are going or not, at least I think there's value in being prepared and doing what you can. So David, we'll have those links in the description field below, and we'll have to do this again sooner than last time. I know it's been too long, but great to catch up with you again.
You too, Chris. Thank you. This was awesome.
Well, thank you, David. Sure appreciate you joining me on the show. Great to have him back on there, as he certainly is quite a market expert. He's been doing this for a long time, and great to get his perspective as things seem to be picking up out there in intensity. So hope you found that helpful at home. And I would also like to thank Raina Silver for bringing us today's show. Raina Silver has been active lately as they have reported high-grade silver and gold results from their Batopilas sampling. 14,371 grams per ton silver with 0.6 grams per ton gold in the historic silver zone, and 32.6 grams per ton gold in the East Belt, 2 kilometers east of the silver zone. And also, they're getting underway with their drilling program in Medicine Springs, their third property that they are exploring for high-grade silver. So congratulations to Raina for everything that they are moving forward there. You can find out more about Raina Silver at rainasilver.com. With that said, going to wrap up for today, but we'll see you back again tomorrow with an interview with Lynette Zhang.